VanWest Trust Company, and I wanted to welcome you to our webinar today. We have a special guest, Jake Vanderslice. He's going to be doing a presentation involving self-storage, but before we go ahead and get into the presentation, I had a couple of very quick announcements. First off, I wanted to say thank you to everybody who attended QuestCon Live this past weekend. It was a phenomenal event. Jake, you were actually part of the panel, I believe, with about self-storage, actually. So that was fantastic. Just a couple of quick reminders, guys. We have free education literally all the time, like free webinars all the time. And so I wanted to invite you guys, like, yes, we have today's webinar as well, but make sure that you're signing up for the other ones too. I know we have our happy hour, which is coming up tomorrow. I believe today is Tuesday. Yeah, a Wednesday tomorrow at 5:30 Central Time. We picked these up back in August. It's a great way to network. So grab a beer, grab a glass of wine, and you can talk to pretty much everybody across the country. And we get a really good crowd here. It's usually led by our IRA specialist, Haley Gant. So I'm going to have Sarah, she's going to be moderating for me. She's going to put the link to, reserve your spot for that webinar for tomorrow. So make sure that you're, attending these happy hours, because they're a really great way to still network during like this pandemic, this COVID situation. So make sure you do that. We also have our self-directed IRA Saturdays, which will be, this Saturday. So make sure that you are attending that one as well. It's actually going to be about the benefits of investing into multifamily. And so if you're interested in multifamily at all, or you just want to kind of get into it, or whether you're are experienced or not, make sure you attend. It's going to be a great webinar, and it's also free. So why not, right? And then last but not least, before we get into the presentation, Jake, we are on YouTube and we post 3 times a week. So not only do we get like a lot of education for these webinars, but we also get specially crafted YouTube videos that are done by yours truly. So make sure that you are subscribing to us on YouTube. We post a lot of great content on there. So that's really it. Jake, the floor is yours for the next hour or so. Can't wait to see what you got.
All right, sounds good. Hello, everybody, and thanks for hosting us, Quest. We really appreciate it. Let me get my screen share turned on here. For some reason, we don't want to go into presentation mode. There we go. Okay, can you guys see that okay?
Looks good.
All right. Well, good morning and good afternoon, everybody. My name is Jake Vanderslice. We appreciate you joining us today. I'm a principal at VanWest Partners. We are a real estate investment company based out of Denver, Colorado, and we're investing in a variety of asset classes, but our primary line of business is self-storage. We target deals that are distressed and efficiently managed and with upside in both cash flow and capital appreciation. And we got into the industry in 2015 because we identified self-storage as an asset class that there was really a lack of private equity presence in the industry. And at the time, and even to a degree today, over 70% of owners in the United States are mom and pop owners who own just 1 or 2 facilities. So since 2015, we've done 23 facilities. We're in 6 different states. And we formed an in-house management platform called Clear Home Self-Storage. That's just a quick overview on who we are. And today we're here to talk about kind of the state of self-storage in 2020 in the midst of the pandemic and all the economic fallout that we're experiencing. And hopefully you can walk away from this presentation kind of having an understanding of self-storage as an asset class, what it means to invest in self-storage, as well as some takeaways on the overall state of the industry and state of the market. And no doubt we're going to touch on the pandemic. We have to. I think we're all tired of talking about it, but it's important to kind of draw some parallels in what we're seeing with the fallout in the industry as well. So really, self-storage is among the most defensive real estate asset classes in the face of economic downturns and recessions. Over the past 30 years, self-storage utilization in the US has almost tripled from 3% penetration back in about 1988 to over 8% consumer penetration as of 2018. And I think that's increased in 19 into 2020. And the asset class really serves a critical need in the lives of consumers as they relocate, they downsize their living accommodations, or they simply aim to reduce clutter in their primary residences. And really, history has proven that in downturns, similar to the current environment in the US and really worldwide, self-storage demand generally experiences pretty lasting tailwinds. And our expectation is that as the crisis is ballooning and unemployment is translating into major job loss and major displacement in our national footprint, we're going to see significant demand in self-storage units for the coming years. So self-storage as an asset class really works because the population of the US is fundamentally mobile. People move, they start businesses, they go from state to state. Pretty much everybody is a potential self-storage customer. And the simple genius behind the asset class, and this isn't our genius, it's just self-storage, is that every lease is 30 days. And people can come and go as they please. And that flexibility is very appealing to our customer base. And even though they think they're going to be there for a few months, they'll often stay there for years at a time. If any of you have ever leased a self-storage unit, I wouldn't be surprised if you stayed in the unit longer than you thought you might. And the month-to-month lease is also interesting on the ownership side because you're able to incrementally increase rates with a 30-day notice to your customer base. So an increase of maybe $10 per month may not seem like much, but when you amortize that across hundreds or thousands of units potentially, you start to see some pretty meaningful increases, not only in the equity dividend yield on the facility, but in the gross asset value as well. And when you increase rates, customers generally don't move out because of the inconvenience. Renting a truck on the weekend, getting a buddy to help, we're generally able to put through these nominal rate increases without seeing much, if any, of our customer base move out. And self-storage also works because of the granularity of the revenue streams. And by that, I mean, we're relying on thousands of people to pay us anywhere between $30 to $300 a month versus multiple large tenants, for example, like in an office or retail building, are paying substantially higher gross dollar monthly rates. So one example we often use, we own a retail building here in Denver. We have a brewery that's paying us $15,000 a month. And they're either going to pay their rent or they're not. And if they stop paying, it'll be a lengthy process to get possession of the space, probably a year of downtime to find a new tenant, especially now, and probably $200,000 in leasing commissions and tenant improvement allowance. And that's kind of one end of the spectrum. The other side of the spectrum in self-storage, if someone doesn't pay, their gate access gets turned off and they can no longer get access to their unit. And if they don't pay long enough, we overlock their unit, auction the contents, then get the unit back in service to a paying customer so they can move in and keep their stuff there and hopefully pay their bills. Another benefit of self-storage is friction. And by friction, I mean it's the friction of people moving up and down the economic ladder, getting new jobs, marriage, divorce, upsizing and downsizing their homes. Really, life changes drive self-storage demand. And for better or for worse, right now, there are lots of people in our country experiencing life changes. So another thing to touch on here too is the technology component of self-storage, and we'll kind of retouch on this later in the presentation. But it's been a critical component, especially during the pandemic and even leading up to it. Gone are the days when self-storage operators require multiple in-house personnel to effectively manage a facility. With little to no human interaction, our customer base can research our facility, identify our available units, and reserve a unit online with a click of a button. They can also move in online, sign their lease online, move out online. They can really have a kind of a contactless customer experience. And we started doing that pre-COVID, not because we saw a pandemic coming, because we wanted just a more seamless customer experience. And turns out that's worked well, given what's happened. People don't want contact with other people, obviously. Another component of self-storage that's important to discuss briefly is we kind of do a quick overview of the asset class, or the ancillary revenue streams that self-storage offers. So right now within our portfolio, 8% of our top line revenue comes from ancillary revenue streams. And ancillary revenue streams include things like tenant insurance. So it's kind of like car rental insurance, but you're getting your contents insured for a fairly low monthly premium. Late fees, believe it or not, those add up to be pretty meaningful. And then administrative fees, Typically, administrative fee is a one-time move-in fee when a customer moves in. So interestingly, in self-storage, you don't want your facility to be too full because you want churn. And as you churn customers over, it's a new revenue event every time a customer moves in, and it's a new opportunity to increase rates as well. So that's one important thing to talk about also is unit turnover. The continued industry trends reflect increased lengths of customer stays. So 60% of consumers are now renting units for over 1 year, and 45% of consumers are extending their rentals in excess of 24 months. We have some facilities in our portfolio. We've had customers renting units for 5 years, which is amazing because you probably could have bought new stuff by the time you paid 5 years of rent, but out of sight, out of mind. And that's kind of one of the reasons self-storage works. So that's a quick overview kind of the asset class and the fundamentals. We'll move on now to really some of the high-level impacts of COVID. And obviously, no state of the market overview is complete without touching on the pandemic, regrettably. And I know we're all weary of it, but it's worth talking about. So, I mean, we've had the largest infusion of government capital in human history. And obviously, the question remains of how deep the well is and how much further, if at all, the government is going to step up and intervene more. Stimulus payments have run out. Most small business PPP loans have run out and been deployed into payroll and rent. And our expectation that it's going to continue to result in a large amount of customers who are going to need self-storage for the foreseeable future. And as people across the country find themselves out of work or underemployed without a sufficient savings buffer, one of the most effective personal cost-cutting measures is to downsize living accommodations, move in with family, both of which bode well for self-storage demand for the foreseeable future. And we'll touch on this later too, but institutional self-storage investors continue to see positive net rental activity as we are within our portfolio. Delinquency rates right now are in line with where they typically are at this time of the year. And listening to several earnings calls lately with the publicly traded REITs, as well as analyzing our own portfolio, we're not seeing any major negative effects on the industry as a result of the pandemic. In fact, we're seeing positive growth really coming in through Q3 into Q4 year on year, which we'll touch on a little bit more later. And in any market downturn, we've all been told that cash is king. And we believe more so that cash flow is king, especially in today's environment. And we believe this pandemic has ushered in what we think will become a very legitimate period of distress in the U.S. real estate market. We're not seeing fire sales yet, really in any asset class, even the asset classes that were really heavily hit. But this thing was so sudden and so drastic that I think it's going to take some time for it to work its way through the system. And we think we'll start seeing some more discounted opportunities coming up in Q1 and Q2 of 2021. And institutional capital within self-storage also is continuing a pretty robust acquisition pipeline, and a lot of big transactions are closing in the coming months, which we'll touch on in a few minutes. So, given the recession-resistant nature of the asset class, many of the key performance indicators for the sector, like net rental activity, occupancies, delinquency rates, all remain encouraging in Q3 of 2020 and certainly into Q4. We've seen a reduced level of velocity with respect to both move-ins and move-outs during the height of the pandemic as a result of kind of limited customer mobility. But we also saw positive net rental activity, just reduced net rental activity. And we're seeing that with the REITs too. And occupancies throughout the industry remain steady and are actually now at record highs going into coming through Q3 into Q4. But we kind of caution those statistics given that they might be slightly overstated. A lot of operators deferred auctioning units off, which is a common practice in self-storage. I touched on it earlier. You don't pay your rent, you get your unit contents auctioned, and somebody else moves in and hopefully pays. A lot of operators deferred on doing that for a while. So the Q3 numbers might be slightly overstated, but we believe that in the end of Q3, most operators have completed their auction process. And I think the Q4 numbers are going to be really telling. So we'll see what happens. We've also seen throughout the industry collection rates of around 95% of projected rent collections, which is good. It's on 100%. There's been a little bit of an increase in delinquency during the height of the pandemic. We didn't see it in our portfolio, but nationally, it's certainly out there. And that's one thing that we were concerned with for a while, but it definitely turned a corner quickly. So we'll do a quick overview of the capital markets. Transaction volume really dipped during Q2, and that obviously was just because of the extreme uncertainty and the suddenness of all this. But the lull in acquisition activity is slowly beginning to pick back up as more shops transition to active acquisition activity. Many investors who had capital allocations for retail and hospitality, which of course have seen major distress, still have capital to deploy and have found self-storage to be an attractive asset class with strong fundamentals. So we're certainly seeing cap rates being driven down as a result of that increased demand. And we're also seeing really good opportunities start to kind of get diminished to a degree. We think we're going to see better ones in Q1 and Q2, but deal flow is definitely more challenging right now. And with respect to the debt markets, commercial mortgage-backed securities, which are basically securitized debt that are originated by a bank and then sold on the secondary market in tranches. We probably all remember tranches from back in the financial crisis. They're still out there. That type of financing completely evaporated during the height of the pandemic. And it has completely come roaring back really into the end of Q3 with lenders. They've executed a lot of successful secondary market trades. So they've gotten some newfound confidence to start lending again, especially in COVID defensive cash flowing asset classes. Traditional lender appetite for self-storage remains strong as well. But lenders in commercial banks are mainly focused on stabilized facilities. They'll still do value add and ground up development, but terms for those types of projects aren't as good as they used to. And however, we're seeing an increase in better terms for CMBS financing on more stabilized assets. We're seeing term sheets right now with debt terms as low as 3% on the interest rate, 3 to 5 years of interest-only financing with a 10-year maturity on a 30-year amortization schedule. So that attractive debt profile is really enticing investors to pay higher prices than historically they might have for self-storage, given the ultra-low rate environment. So that's something we're kind of being cautious of too as we evaluate opportunities. Cheap debt does not make a bad deal good by any means. So that's a quick overview of the capital markets and kind of what we're seeing in the industry. So REIT activity has been pretty strong from Q3 of 19 to Q3 of 2020, and by REITs I mean the big, large, publicly traded self-storage operators. And Q3 results are really signaling positive momentum. So strong consumer demand, increased move-in volumes, muted move-out volumes continue to drive record-setting occupancies and self-storage among the big self-storage REITs. And same-store revenue growth continues to rebound as rental rates increase to existing customers resumes. A lot of folks we talked about rental rate increases earlier on, and a lot of the major players were not doing rental rate increases just given the uncertainty, but those rate increases have started to show up again. And so they're not only getting better revenue growth, but they're also moving more customers in. And move-in rates across the REIT portfolios increased about 5% year over year during the quarter, and then 9% year over year in October. So that's encouraging that the first month of Q4 is 9% over where it was last year. So that feels like we're going into a good position in Q4, but time will tell. And really improved fundamentals help drive that revenue growth sequentially, and it really provides some optimism to all of us in the industry kind of going into this quarter. And the self-storage REITs also posted same-store revenue growth anywhere between slightly negative to slightly positive in the third quarter. So kind of a mixed bag there, but occupancy has definitely gone up, and occupancy rates have reached all-time highs from Q3 of 19 to Q3 of 20. And we'll expand on that on another slide here in a few minutes. And we've also seen, because of the displacement and kind of the shutdowns people have experienced, the stay-at-home orders, we've seen the storage leasing season get extended. Historically, storage leasing kind of slows down in the fall, but we've seen that demand that was kind of pent up over the summer getting pushed into the fall. And continued strong consumer demand and limited move-outs really helped accelerate those operating results subsequent to the quarter's end. The REITs reported occupancy growth increasing up to 420 basis points compared to a year earlier, and street rates pushing into positive year-over-year growth. So street rates are really the asking rate for a self-storage unit. And those had a pretty significant dip during the height of the pandemic. And we've seen those recover to slightly better than they were quarter on quarter for Q3. So that's good news. And that's really just a result of a lot of pent up demand brought on by the pandemic and causing that leasing season to extend into late Q3 and all the way into Q4. So we've also seen accelerated transaction activity with a few notable pending trades that are happening, and really abundant access to historically low cost of capital, which we touched on earlier, is fueling an accelerated transaction market in Q3 and leading into 2021. A couple highlights: Blackstone Real Estate Trust is in agreement to acquire Simply Self Storage, which is nearly 100 properties from Brookfield Asset Management. And it's a $1.2 billion transaction. That's been one of the bigger self-storage trades in, I think, recent memory. And amazingly, the cap rate on that trade is estimated to be at or just slightly above 4%, which is amazing. It's kind of a testament to the notion that large institutional investors will pay a price that is greater than the sum of the parts. That's an extraordinarily low yield on cost for a portfolio of that size. There's also a pending acquisition for Public Storage. They have a 36 property portfolio transaction spread across 15 markets in 13 states. And it's in the early stages of lease up, around 35%, with 12 properties in various stages of development. So that's another big one that's happening. And CubeSmart has a pending acquisition of 8 New York properties from a company called Storage Deluxe, and that's going to be at $540 million. And that portfolio includes 5 deals in Queens, 2 in Brooklyn, 1 in the Bronx. And that pricing translates to about $692 per rentable square foot, which is a crazy price per foot. I mean, we're buying deals between 50 to 100, although they're not, infill, multi-story, Class A, hard to replicate properties, but that's just a crazy number. And that cap rate is estimated to be somewhere in the mid 4s at stabilization in 2023. So not only are they paying a high price per foot, but their yield on cost between now and the next 3 years is probably going to be in the very low single digits, like 1, 2, maybe 3. So people are paying up right now for the asset class, which is definitely a testament to the recession-resistant nature of it, as kind of people build moats around their asset allocation and acquisition strategy. There's one more property portfolio that's worth mentioning as well. And Life Storage had a recent acquisition of 25 stabilized properties for about $325 million. And they bought the interest in 2 joint venture partnerships with Sovereign HFF Storage Holdings, and locations are throughout the Northeast and New Jersey, Pennsylvania, and the Southeast, in Florida, and the South, Texas. I think there's a deal in Georgia. And the cap rate on that trade is estimated to be around 5%. So definitely seeing cap rates driven down and price per foot going up as capital allocations shift from riskier asset classes to asset classes that are arguably recession resistant. So here's kind of an expansion on the year-on-year performance of the REITs. And Public, Extra Space, CubeSmart, and Life have all enjoyed increased year-on-year occupancy levels from Q3 of 19 to Q3 of 2020. And once again, with most operators having delayed auctions, there's a possibility we could see a dip in Q4 of 2020, given it is generally a slower time of the year for self-storage customer demand, and that most auction units have worked their way through the system by the end of Q3. But Q4 will really be a telling quarter to really gauge how self-storage has performed. And with the possibility of additional shutdowns and stay-at-home orders, it will be tough to really normalize the data set until we have some sense of stability, whenever that may occur. If we have a bunch of markets shut down again in Q4, which is a certainly a possibility we could see auctions getting delayed again and kind of results getting a little more opaque. So we'll tell you what happened in a year from now, but it's really hard to tell right now. The verdict is still out, very much so. So looking into 2021, the steady performance of the self-storage sector throughout the pandemic really raises hope that the industry is going to move out of recession territory and potentially into a strong recovery. And we're already seeing indications of that, which I mentioned a few minutes ago. And really the combination of strong move-in volumes and muted move-out activity in July, September, and October pushed occupancies up to these near all-time high records that we touched on. And the positive impact on occupancies really is due once again to those auctions being delayed, but that's narrowed. So we're hoping that most of those have worked their way through the system, and the data set we're looking at is actually accurate and what's truly happening. So looking forward into 2021, this downturn is hard to compare to prior downturns because of the speed at which things just came off the rails. So it's hard to make forward-looking statements based on past recessions because this simply isn't like past recessions, of course. So, however, this is generally what we're seeing in the industry looking forward into next year, which we're almost into, 45 days away or so. So we're obviously in a low interest rate environment, and the desirability of the asset class with lenders helps maintain liquidity in the debt markets for self-storage assets, which has really bolstered a lot of the acquisition activity that we touched on a few minutes ago. Banks, life companies, CMBS, and non-bank investment management companies are really actively quoting terms for deals right now. And higher leverage and longer interest only periods are now available, which we discussed a few minutes ago. And those were completely absent from the beginning stages of the pandemic. So in short, we're seeing debt sources just really rebound and come back, which is in turn spurring additional acquisition activity. We also expect to see more downward pressure on capitalization rates. It remains an attractive asset class with favorable risk-adjusted returns, and the widening spreads between the cost of capital and cap rates is really making it more attractive, and improving market fundamentals are pushing those cap rates down below actually pre-COVID levels. So believe it or not, cap rates are now lower in the midst of this whole fallout than they were in Q4 of 2019. And really the scarcity of the availability of stabilized offerings is creating very intense competitive bidding for available assets. And for example, if you have a new Class A multi-story climate controlled facility in a dense urban infill location and you're at 90% occupancy, like we touched on earlier, those cap rates could be driven down as low as 4 or 4.5%, which is just an insanely low yield on cost. We expect to see, in addition to compressed cap rates, we expect to see a bifurcation between cash flowing deals and more distressed deals or ground up development deals. Cash flow is once again king for private equity and public storage investors. And the appetite for assets that are able to generate targeted risk adjusted returns is really driving demand up on those asset types. And to a degree, demand is somewhat soft on less stabilized properties, properties that might be in lease up or development. And we're seeing that turn the corner a little bit, but we've certainly seen development activity get reduced. A lot of the markets that were oversupplied across the US have seen a reduction in new construction activity, really starting in early Q1. And extended projected lease-up timeframes and the uncertain trajectory of rental rates as it relates to COVID and everything we have going on is just really driving up that increased demand for stabilized product types. And we touched on this a little bit earlier, and we'll expand on it now as we kind of close this out. But another big shift in the industry has been a shift to contactless rental platforms. I mentioned that we started doing this a little while ago, but a lot of the big REITs who are averse to it, for example, Extra Space, you had to go into a leasing office to lease a unit, and now you don't have to anymore. And the pandemic has really forced operators, both large and small, to rethink operations and create efficiencies in customer interaction and trimming operating costs. And really a silver lining of the crisis has been the increased popularity of the contactless rental platform. And companies ramped up various rental platforms to kind of stay at the forefront of the stay-at-home orders and the various restrictions that we've been seeing. And obviously going to 2021, another big aspect of all this is just the uncertainty of the markets. The contentious election environment, we don't know who's going to control the Senate, the possibility of the elimination of the 1031 exchange, which I've been told the chances of that are pretty low, but you never know. That could really affect the market. Liquidity as 1031 sellers maybe just become holders and they refinance instead of sell. So that could really seize up transaction activity depending on what happens. But just general uncertainty going into 2021 is what we're feeling. And most operators like us are really just trying to focus on properties that have some value creation, but that also have good in place returns and good in place cash flow with strong market fundamentals. So the verdict is very much out on what next year looks like in self-storage, but the writing on the wall so far is that the asset class has really performed fairly well, especially as it relates to other asset classes like retail and hospitality. So we're confident in the strategy going into next year, but we're certainly employing a large element of caution. So yeah, we took about 30 minutes there. We have an hour, but that's a quick overview of self-storage as an asset class, touched on a few of the fundamentals, the current state of the market, and what we see going into 2021.
Fantastic. All right. Well, that was a wonderful presentation on self-storage. I definitely learned a lot. So guys, we're ready for some Q&A. If you guys have any questions for Jake, I'm sure you do. I know we already have one, it looks like. So let's see here. Victor says, Jake, I am in the Dallas-Fort Worth area in Texas. I have noticed a huge demand for RV storage. Would you also have a mixture of self-storage as well, or just RV storage?
Yeah, we have seen a major increase in boat and RV storage in the last couple months. And apparently, if you're an RV dealer, you can't keep enough inventory in your lot right now because they're so popular. I've got a few friends who, when COVID kicked off, they decided to homeschool their kids and bought an RV and have been all over the country. So it's definitely has been systemic. We have not done a deal yet that is only boat and RV parking, but we have added boat and RV parking to a number of our existing facilities. So we have a location in North Carolina right now. We spent about $100K adding a parking lot onto that with large boat and RV spaces. And we opened it up for leasing about a week ago. And we've leased 6 out of the 60 spaces already. And it's just kind of catching on the market. But you're absolutely right, Victor. There's been a big increase in demand for boat and RV storage. We're under contract to acquire a portfolio in Michigan and Ohio, and a few of those facilities have major boat and RV components to them. Like you've never seen so many boat and RVs, at least I haven't. I mean, they're just acres of them, and I think their occupancy rates on that component is like around 90%. And a lot of municipalities right now, I'm sure it's the case in Dallas-Fort Worth, will not let you park your boat or RV in front of your house. HOAs restrict stuff. You just can't put it there. And with all these people buying boats and RVs, mainly RVs, they need a place to store them. And yeah, you're absolutely right. There's been a big demand for that the last couple of months. And we see that continuing. We might explore deals that are only RV and boat storage, but we haven't gotten there yet. We're just kind of adding that onto our existing traditional self-storage facilities.
Nice. I can definitely say that my dad has been thinking about getting an RV, and probably just going to show with all the huge influx of all that stuff.
Yep.
So I have a couple more questions here. Robert says, your thoughts on building a storage unit, like building a storage unit? I guess that's one of them.
Yeah, it depends. The fundamentals that we focus on when we've done a fair amount of ground up development. We haven't done much of that lately just because of the time to revenue. But what you want to analyze when you're evaluating a self-storage development opportunity, first and foremost, it might be obvious, is can you build self-storage on the site? If the zoning is not a use by right, it's often difficult to get it re-entitled to a different use to build self-storage. A lot of municipalities are kind of averse to self-storage. So it's more difficult to get projects approved if the land use does not already allow the use. And assuming the property does allow self-storage, the next thing you have to look at is the supply ratio of the submarket. So self-storage is very local supply sensitive. So we typically analyze our deals in a 1, 3, and 5 mile trade radius. And one could say that Denver, for example, is oversupplied, or Seattle or Houston, which is true. But there are plenty of submarkets in those MSAs that are not oversupplied. Typically, we target acquisitions in submarkets that are 7, maybe 6 square feet per capita or less. And if you can get acquisitions or build new facilities in submarkets that are undersupplied, you can weather the storm in the event that a new operator comes in and builds a new facility. And then beyond that, really just analyzing rental rates to make sure that your yield on cost is going to make sense. In self-storage, you can't just say that a 10 by 10 leases for a certain amount. A 10 by 10, for example, by the front door might have an increased premium on the rental rate compared to a 10 by 10 that you have to walk 100 feet to. So the point I'm trying to make is that revenue management in self-storage is very dynamic and very granular. And as you evaluate a new facility, you need to understand what the rates are on a 10 by 10, on a 5 by 5, on a 10 by 20, and layer in all those rate assumptions into your pro forma to make sure that your revenue expectations are achievable. So number one, is the land entitled for storage? Number two, is the market supplied in a way where you could build a new facility and not have the market be oversupplied? And number three, you got to get a good handle on your revenue streams.
Good information. So looks like we got a couple more questions in. Let me see. Okay. So I have one from an anonymous attendee who says, when evaluating potential storage operator acquisitions, is there a minimum number of separate facilities or locations that are required?
That's a really good question. And that's a question we often grapple with. Doing a small deal takes as much time, if not more time, as doing a big deal, right? You still have to call the bank up. You still have to raise the money. You still have to order a survey and a phase 1 and maybe a phase 2 and a property condition report. So we typically shy away from individual acquisitions that are smaller. We will buy smaller deals as part of a portfolio. So one really good example I can think of is a set of properties that we're under contract in Michigan on. And it's a 5-property portfolio. 2 of them are pretty nice and pretty new. And one of those 2 operates several satellite locations down the street from it that are not as nice and not as new. So as long as you have geographic concentration and some scale, you can afford to buy smaller properties in aggregate and kind of spread a lot of those fixed costs across those properties. Typically, it does not make sense unless you just want to get in the business and kind of be a self-operator. Typically, it doesn't make sense to go out and buy one 20,000 or 25,000 square foot self-storage facility, because you just can't take those fixed costs and amortize them effectively over a very low number of square feet. So we generally try to achieve geographic concentration when we enter a new market and spread our fixed costs across numerous facilities. We typically don't try to go in and just buy one deal in one market. We did that as part of a 1031 exchange in Ankeny, Iowa. And the deal's going fine, but we can't find more deals out there. And our expense load, in our opinion, is a little bit higher than it should be because we just can't spread those costs across multiple locations. So if you buy a big deal, for example, maybe 40,000 or 50,000 square feet, that makes sense just to buy that one property because there's enough revenue on it where you can spread those costs across the facility. Hope that answered the question in a roundabout way.
Yeah,
try to buy more and spread the costs across, I guess is what I'm trying to say.
All right. So our next question is, are you guys involved in storage valet?
We are not involved in storage valet. We're not. I think I'm familiar with storage valet. If I'm thinking of it correctly, it's one of the companies that will pick up your stuff and put it into like a multi-story warehouse. If it's not, forgive me, but I think that's what they do. So we have seen a number of those companies out there, and that's definitely for a certain customer type. Interestingly, most of our customer types like to get access to their contents often. So for example, we have a Pensacola facility that's about 500 units with a parking component as well. And a couple months ago, we had 3,000 gate access entries over the course of 30 days. And we definitely don't have 3,000 customers. So what that indicates is people are coming and going to get to their stuff often. And if you're a person who likes to do that, putting your stuff into a container and having it driven into a multi-story warehouse, you probably are not going to be the person who wants to use that storage solution. But maybe you just moved and you're trying to find a house and you're living in an apartment for a while. You just need a place to park your stuff. That might be a customer type that would benefit from something like that. But the lack of access to their contents is one issue we've seen with that.
Okay, good deal. Let me see. Let's see if I can find a good question here. Okay. Christopher says, with low cap rates and high occupancy percents, is it better to hold on to facilities rather than selling right away?
That is the debate for the ages, is when do you sell? I often say that I am a great buyer and a terrible seller. And one of the many mistakes that we've made over our real estate careers that we continue to make, I like to say we get less stupid every year. One of the mistakes we continue to make is sometimes being enticed by a crazy price and selling too quickly. And the enticement of that crazy price is always interesting because you might have a large equity multiple, you might have a large return of capital, large liquidity event. But when you sell, all of your value creation, all the effort you put into that deal, all the time you invested and all the risk you took is immediately quantified and it's over. That income stream is gone and it's done. And then once you sell, the first problem you have is you have a tax problem, right? You either pay a big tax bill if you did well on the deal, or you 1031, which increases the possibility of you buying a bad project because you're under the gun from a timing perspective. The second problem you have when you sell is you have money in the bank that's not making a yield. It's nice to look at your bank account with a bunch of cash, but it's making zero return. The third problem you have when you sell is you have to redeploy that cash into a new investment and take a new risk and do the whole thing over again. So the last couple of years, we've really tried to focus our strategy on acquiring assets that are going to be durable and they're going to create long-term repeatable income streams. And a sale is contemplated in our modeling down the road, maybe in 5 to 7 years, but it's not required to make the pro forma make sense. So selling or holding is a tough question to answer. It just depends on the deal and your personal goals. But it's a debate that we often have amongst me and my partners. And we generally land on holding for the long term, but we're also guilty of selling too quickly here and there as well.
All right, sounds good. So I have another question from an anonymous attendee who says, do you see more success in climate controlled units or more traditional drive up non-climate controlled units?
It depends on the market and it depends on the location. And I'll give you a few examples. So a number of operators are building multi-story climate controlled facilities in what I would say are fairly non-dense suburban locations. And the disadvantage to a multi-story climate controlled facility is the inconvenience of loading and unloading. So you park your car next to the building, you put your stuff on a cart, you walk down a hallway, you get on an elevator, you might have to wait for the elevator. You have to wait for the elevator to go up a few stories. Then you walk another 100 feet, you load and unload, then you go back and you do it again. So multi-story climate control facilities, we think, perform best in really dense markets where customers do not have alternatives for storage. They don't have an alternative to go to the 4-acre facility with 500 drive-up units. Within our portfolio, we have both. So we have infill multi-story climate controlled facilities that command higher rents. And the reason they command higher rents is, number one, they're climate controlled. And number two, the unit mix is smaller. So the average unit size, because each unit is smaller, you can push up the price per foot without a big gross dollar increase. We also have facilities in markets that have a combination of climate controlled and non-climate controlled. So you can show up to the property. There's a nice kind of interior climate controlled single story component in the front. And in the back, there's a bunch of drive up units that are non-climate controlled. And it depends on the market, but the rate deltas can be anywhere from 25 to 50 cents a foot, sometimes higher. Obviously, you're going to get a premium for climate controlled, but in multi-story climate controlled facilities, for example, we have a location in Milwaukee that's got mezz space on the second story. And our rates on those units, because you have to ride an elevator up, are much lower than the units on the ground floor. So there's definitely a delta in the premium and the rates. And climate controlled versus non just kind of depends on the market.
Okay, good deal. All right, so we have a couple more questions. So Victor here again. Probably should go ahead and do this now. That way people can get your information. Victor says, Jake, how would I get in touch with you when I find an awesome deal? The reason why I asked about the RV storage, I have located so much vacant land in the outside of city limits to build an RV storage on it, looking to get quotes on gravel instead of paved. So can you let everybody know what your contact information is, and I'll try to put it in the chat real quick.
Yeah, best way to get a hold of me is I'll give you my phone number and my email. Email is Jacob, Jacob, at vanwestpartners.com. And my cell phone number is, I'll just put this in here myself, 720-299-98997. So it's right there.
Let me copy this real quick.
And Victor and everybody listening, if you have deals you think are interesting and you're not ready to fund them or buy them yourself, we are happy to pay people finder's fees. We've done that many times in the past. I think we paid a $200,000 finder's fee a couple of years ago. All we care about is the total basis on the deal. Does it make sense or not? So we're totally fine doing that. But if anybody has a deal, we'd love to hear about it to see how we can work together.
All right, and then kind of, okay, I'm not mute. Okay, perfect. And kind of leading into that, so we know that we do like a lot of these webinars and networking events, guys, with like the happy hours, but is there anything as far as like resources to find deals that, you can talk about, Jake?
Resources to find deals. Let me think here. So one of kind of the better self-storage educators that we know out there is a guy named Scott Myers. He's kind of made it around this circuit before. I think he's a great guy. We were on a podcast with him about a month or two ago. He has access to a lot of deal flow, and a lot of his students bring deals to bear. Beyond that, we source most of our deals a couple different ways. Traditional broker relationships. So sometimes we'll get a deal before it gets listed. Other times we'll find deals that are inefficiently marketed, and there's some arbitrage there. And we got started doing single family fix and flips. We've done over 1,200 of them all over the country. And we applied our single family marketing techniques to sourcing self-storage deals like direct mail. So we send business letters out to sellers basically saying, hey, we're a buyer, we're not a broker. We'd love to take a look at your facility. We might be able to pay you more than you expect. And I think we placed about 10 million in capital off a $4,000 direct mail campaign. So that works too. And obviously you have to scrub the list and make sure you answer the phone, but that's another way to source properties.
And so it looks like we have about two more questions. Two more questions. So I have one from Tanweer who says, do you use syndicate method for acquisitions? What is the expected annual cash flow for such investments?
So we have historically done two things. We've done single asset syndications where we raise money just for a specific deal. We've also done fund structures, which is a combination. It's basically a syndication, but with a collection of assets versus one location. We're launching our new fund now, and our capital structure is an 8% preferred return. And then everything thereafter pays down capital accounts. And after capital accounts are completely returned, the split is then 70-30 in favor of investors. And we're targeting anywhere between a 15 to 18% IRR and roughly a 7-year time horizon. And our main focus within our fund structures is cash flow. So we're only buying deals in aggregate that will enable us to continue distributing cash flow to both us and to our capital base. We're still looking at development and more heavy value add deals. We're not doing them right now, but we're looking. We will not do those inside of our fund structures because of the yield drag that deals like that with no income will cause on the overall fund level returns.
Okay. And then let's just do one more because the rest of them are really about the IRA part of it. But another anonymous attendee says, how do you choose your target markets? I concentrate for efficiencies or diversification. Is concentration for efficiencies or diversification more important?
Yeah, it's an easy answer. Obviously kind of a cop out, but it's really both. So the current markets that we're in are Colorado, Florida, North Carolina, Illinois, Wisconsin, Iowa, and Tennessee. And we're soon going to be in the Ohio and Michigan markets. And First and foremost, we like good real estate fundamentals. We want positive population growth. We don't want an oppressive tax environment. We just want good, robust demographics in any market that we're targeting. And as we drill down on the kind of sub-market level, the next thing we look at are supply ratios, which we touched on a few minutes ago, in the 1, 3, and 5 mile trade radius. But as I mentioned, we don't want to just do one deal in one location. We want to acquire several, and we want to do deals in markets that have good fundamentals where we can also get management efficiency concentration. Geographically, in general, I would say we're to a degree somewhat agnostic. There's not really anywhere specifically we just won't do a deal, like state-wise. There's some states we might shy away from a little more for a variety of reasons, but if there's a good property in a good location with good fundamentals, we'll be interested.
Cool. All right, so the rest of them really are about how to use self-directed IRAs with self-storage. So guys, if you have questions about how to utilize self-storage within your self-directed IRA, give us a call at 855-FUN-IRAs, or email us so you can talk to an IRA specialist right off the bat at iraspecialists@questtrust.com. And Sarah's going to put that in the chat below. But give us a call, shoot us an email. We'd be happy to do a free consultation with you about how you can, use self-storage, use all the information that you learned from Jake today within your self-directed IRA. So make sure you're reaching out to us, scheduling those consultations. And then also, if you had gotten here late or you want to replay this video, it's on YouTube and Facebook right now, and it's going to post after this as well. So this is another indication of why you should be subscribing to our YouTube, guys. We post all of these webinars right directly on our YouTube, so you can go back to them. We got another question, looks like, real quick. So this will be the last question, then we'll probably close out. But Fred asked, does self-storage benefit from the Opportunity Zone program?
It does. Opportunity zones are tricky. We haven't targeted deals specifically in opportunity zones. If a deal happens to be in an opportunity zone, it's kind of icing on the cake, but we want the real estate to stand by itself. So yes, it does benefit from those, but the OZ rules are kind of, rub your tummy, pat your head to a degree. They're complicated. So we're not specifically targeting those, but self-storage is definitely an asset class that can benefit from a lot of those tax advantages in the opportunity zone areas.
All right, guys, that's all we really have time for today, unless you have more questions to ask Jake specifically and not about IRAs within, self-storage investments. But again, see Jake's contact information in the chat. He gave his email and his phone number. So make sure you reach out to him if you have any further questions about self-storage. And then also, if you have questions about how to utilize self-storage investments in your self-directed IRA, give us a call too. You can see in that chat below, again, we have our phone number and our email. Set up that free consultation with us, guys. And then also subscribe to our YouTube. This video will be on there so you can reference back to it. Jake, thank you so much for that wonderful presentation. I learned a lot. I hope you guys did too. Any other closing remarks before we, head out for the day?
No, thanks for having me. I really appreciate it. And as you mentioned already, I encourage anybody with any questions to reach out to me. Love to connect, and maybe there's a way we can do deals together.
All right, fantastic. All right, everybody, you guys have a great rest of your Tuesday and the rest of your week. Happy investing.
Thanks,
Bye,
Nicole.